Hey guys, Dave with Moniology here. Hope everyone is having a great weekend. This is the weekend market review on the weekend of January 20th and 21st, 2018. Thanks for joining me, and let's take a look at what's going on in the markets today. Starting with the daily chart on the 10-year U.S. Treasury yield. So as we've been calling for the last couple of weeks now, we finally broke out of the 2.6 level. This is something that's potentially a game changer. This is a very big development, and it's further sign that inflation is starting to really pick up, and it looks like yields are headed towards the 3 level. May not get there right away, but definitely something, a development worth noting. Now, on the weekly chart, here's the most important part. Well, now we're going towards that 2.7 level, and we're creating new highs on the MACDs, which is very good. I see a little bit divergence here. So we're at 2.26.37 or 2.637. Last time we hit a high of 2.621. Yet the momentum was much higher then than it is now in the weekly chart. So that's something that has to be rectified for prices, for yields to continue to move up towards that 3 level. So we'll see what happens. But as you see here, it's created a very nice move. It's above the middle Bollinger Band, above the 50 and 200 weekly moving averages. MACDs, or in this case PPO, basically the same thing, are looking very good. And so from our standpoint, the probability is that yields are moving higher, and if you're in fixed income, well, the prices are likely moving lower. Now here's the monthly perspective of what we're seeing. This is very key. Because the perspective is what gives us the confidence in our probabilities. When you look at the RSI, which is the most important indicator, it's breaking out here, and that's very important. Look at this move here; that's powerful. And from a monthly standpoint, this next price point is really at 2.98 or 3%. Once we hit that, that's when I think that there'll be some very strong resistance and consolidation. But until then, it looks like it's a straight way up in yields. And looking at gold, which is basically directly related to yields, this is the daily chart. Now you're seeing a little bit of almost like weakness when you want to see strength. So I think we'll hit 1360 in the not too distant future, but look at the MACDs. The MACDs are kind of rolling over, and it's very possible that we're going to do a little bit of a shakeout here on gold, possibly to test that 2090 level, or possibly as low as the 200 moving average at about 1280. So we'll see what happens in gold. We like the gold play in the next coming months, but in the next couple of weeks there may be a pullback, so something to be cognizant of. So now taking a look at the gold weekly chart. We broke out of this downtrend that we've had since 2016. We've consolidated by back testing it several times successfully. We're above the middle Bollinger Band, and now we're moving. But again, we're moving, and the momentum is not as strong here as it was last time around in September when we tried. So that means that the probability is relatively high that we might consolidate here either in time for a couple of weeks or possibly in price for a couple of weeks, maybe retest the 50 RSI from the upside and then break out higher to make a run towards that 1380 marker. But gold is bullish, but in the short run would not be surprised. I'd say there's over a 50% probability that gold does pull back just a little bit. But looking at the larger perspective, since 2011 we've been in a downtrend. Now that downtrend has been broken. That's without question now, and now it's just a question of how quickly does it move up and break that 1380 level and make a run towards somewhere in the 15 to 1600 range. I think that's when it breaks that 1380 level. That's when the institutional investors and traders will be convinced that it's time to get into the miners full scale. So you want to see this break on a monthly of RSI above 60. If it does so, then that's when we'll really make a push toward multi-year highs. But gold and precious metals are one of the main sectors you want to be looking at in 2018, without question. Now you got the high yield daily chart. It's had a little bit of a pullback. The MACDs are now below zero, and we're consolidating here above the middle Bollinger Band on the daily, right above the 50 daily moving average and above the 50 on the daily RSI. If that can hold, that would be very bullish and likely suggest that we're going to move higher. But on the other hand, if that breaks, then you're likely looking at lower prices in high yield. On the weekly chart, now I've been pointing this out. We kind of broke it down from this bearish wedge. We've been consolidating through time, which is not a bad development, but RSI momentum has been continually weakening, and until it can break out on RSI, not on price, but on RSI and momentum above that 70 level, it suggests that eventually we likely move lower rather than higher on high yield. Bottom line is fundamentally, I mean, high yield can't move up much higher. I mean, the yields there are not too far removed from the 10-year Treasury and dividend stocks. It's kind of ridiculous, but when you look at the monthly, it looks fantastic. It's in that super overbought range above 70, but that's where you want to be if you're in a major uptrend. Now, look at the MACDs; they continue to curl lower, and if that breaks lower below zero, then that's going to be our sign that things are indeed looking down on high yield. And you'll see in the VIX chart on the monthly basis, the MACDs are doing the complete opposite. They're circling up and very, very close to breaking above zero. Is that coincidental? Maybe, but it's definitely something worth considering, because if volatility starts spiking and the markets start correcting, this will without a doubt break lower. So let's take a look at oil on the daily chart. Now, oil, we've been very bullish on oil since 2000, since basically the middle of 2000. I don't remember exactly, but start of 2017, oil looked very bullish. When we hit a low of about, here we go. When oil hit a low around 42, we saw some divergence building here, and we said oil is looking to move higher. And sure enough, it did, and we had a massive move when a lot of the great traders were suggesting oil was moving lower. And that's, again, largely in part due to our longer-term perspective on the weekly and monthly chart. But now we're seeing some divergence to the downside. And so while we're still bulls on oil in the next couple of months, I think right now we're setting up for a pretty sizable pullback. Now, taking a look at the weekly chart, you've got a multi-year top here around that 63 level. So no surprise that we've got a point of very strong resistance. And but on the other hand, we've got very strong momentum. Look at our momentum here versus when price was at that same level years ago. Now, that's a very positive development. But nonetheless, you look at the fundamental picture, and it's extremely speculative positions are at extreme levels on the long side, and we're going to likely shake out some weak hands here. A break below the 200 weekly moving average likely takes us to the middle Bollinger Band. Wouldn't be surprised if we go as low as 50. Now, the chart itself on oil doesn't look so bad, but when I look at the individual names, and we'll likely make a video posted today, the individual names are not following through anymore on this oil up move. Now, the majors have finally caught up to the price of oil over the last couple of weeks, but now all the small caps and various different names are just showing a lot of weakness. So it doesn't give us confidence that we're ready to break out above the 65 move. But this, as you'll see on the monthly chart, is an inverse head and shoulders pattern here that eventually breaks to the upside. And this is what we're talking about here. It looks very good, but 61 level of RSI is a very, very strong level of resistance. And so ultimately, there's going to be some consolidation that needs to be had. And I think that makes sense to have this above that 50 level before we move higher. Okay, so moving on here. When the browser decides to cooperate, we got the NASDAQ. These videos that we kind of been going very quickly over the Nasdaq and S&P, because frankly it's exceptionally bullish. There's nothing to see here. If you're long, stay long. If you're not long, I wouldn't advise to go in this trade, because the risk reward is simply not there yet. But it's exceptionally overvalued. But from a bullish momentum perspective, if it's above 70, in this case it's 85 on the monthly, I mean, it's insane. And at some point this is going to crash. But until signs point to a crash, you have to assume it's going higher. And that's what's happening with these trend followers. Now the Russell has been not as strong as the Nasdaq, and it's been kind of having trouble breaking above that 70 level. Which could be viewed as consolidation here, or it could be viewed as the beginning of a breakdown. So we'll see what happens on the Russell. Now the Russell weekly looks strong. It's well above that 70 level, and the Russell monthly is very strong as well. So S&P, very strong, well above that 70 level on the daily. Sorry about that, browser issues, but I'm sure it'll come through for us in a moment. Here we go. S&P weekly looks at 88. I don't think I've ever seen a market be so overbought, and really very little concern on the monthly. 88. That's just simply insane, and I'm just watching it with awe. But ultimately, it's creating multi-year highs on the MACDs and the PPOs, and so it's exceptional. And eventually, when it breaks lower, there's going to be a lot of pain. But until then, it just looks fantastic. Now, taking a look at the dollar index, the dollar looks very weak, and we've been right. You know, we're not always right, but with regards to oil and the dollar, we've been very accurate. And it's just, while it's consolidating here above the 90 level, and it might make a run towards this 92 level to retest that breakdown, ultimately we think the dollar moves lower, and here's why. On the weekly chart, we're simply breaking down. Now we have positive divergence here. Looking at this here, the price at 90, the momentum is higher than when the price was at was higher. So at 91. That suggests it's possible that we kind of double bottom here and make a run back higher. But on the other hand, MACDs are well below zero and moving quickly below zero. And you look at the monthly, and we're breaking down below 38, and that's a crucial level. If we break below that 200-month moving average at 90, I mean, this means that we're moving towards 87.50, which is not that far down. So I wouldn't be going bearish on the on the dollar at this point. This was the time when we called it here to go bearish. And why were we so confident on that play? Well, look, you had multiple new highs here, 3 new highs, whereas you had 3 new lows in momentum. That's very key to understanding why we were very bearish on the dollar here. And yet you listen to these fundamental guys, these great analysts and economists, and they were saying when we were here that the dollar is going to 110 and 120. Well, this is why technical analysis is so important, because it tells us what's actually happening without any of the emotions and the quote-unquote facts of the market that can be clouded by our personal biases. Anyway, so ultimately we think we head to 87.50. There's going to be a very big level of support there. What happens here is anybody's guess, but we'll be watching very closely. And you've got the VIX. VIX is interesting. It's every time it seems to have a bounce up, it gets crushed. But something tells me now is different. Why? Well, we're hitting new highs in the market, but the volatility is increasing. That's an interesting development. We're above the 50 level on the RSI. That's something to consider on the daily. Now on the weekly, we're above the 50 level on the RSI. That's an interesting development. We're above the 0 level on the MACDs. Now, on its own, that's not a big deal. It's happened before, here, and multiple times, only to get crushed lower. That's true. But this is still a bullish flag. And when you look at this flag on a monthly level, which we'll point to in a moment, The MACD I posted a chart a moment ago saying it's the most important chart in the world. I truly believe. Look at what's happening in the MACDs. If this breaks above 0, this likely coincides with this particular downtrend breaking to the upside, and it suggests that volatility is really going to start spiking. That's not suggesting that we're about to have a market crash, but it's suggesting we'll see a lot more 1 to 2% down days than we've seen over the last 5 years. And it's very possible the last time this happened was, frankly, right about here in 2005. We didn't see much change for a while. Then again, it happened in 2011 when we broke above 0, and that's when we had that massive correction in August where markets fell about 20%. So I would say that the probability is increasing that we're setting ourselves up for a pretty nasty correction, and we'll see what happens. But the VIX is very important to keep an eye on. Finally, here we're going to look at the world index, and on the weekly chart, it's breaking to new highs. This is something we've been very bullish on for a long time. We've pointed this out around early September or early 2017, saying the emerging markets are definitely where you want to be, both in absolute terms as well as relative terms relative to the U.S. markets. The U.S. markets have done great, but the trend certainly, here's kind of an inverse head and shoulders, the trend has certainly reversed to where you want to be long emerging markets relative to U.S. markets. Now, we've pointed out that we see us making a high of 2,400 here and ultimately doing a double top in emerging markets. This is the world index, but the same applies on emerging markets. We've broken out of multi-year highs. The MACDs are at multi-year highs, and RSI is at multi-year highs. It's basically the perfect recipe for up moves in the market. Anyway, guys, this is it for the weekly market review on the weekend of January 20th, 21st, 2018. Let us know what you think. We appreciate your feedback, and ultimately we count on you for our support. So please go to that link below in the show notes on Patreon and show us your support by sending us a $10 to $25 donation for the work that we do. It's going to really help us improve the quality and quantity of these videos, work on our website, and ultimately create much better content much more often and much more personalized content. And I think that's going to really help you guys. It's going to help us hire other traders, bring on other partners, and I think you'll really appreciate the work that we're looking to do here with Moniology in 2018 and beyond. And it ultimately depends on your support. So thanks, and have yourselves a wonderful trading week.